Welcome to the Investors Podcast. I'm your host, Trey Lockerbie, and today I have with me Chris DeMuth Jr. from Rangeley Capital. First time on the show. Chris, welcome to the show.
Thanks for having me.
Really looking forward to this one because a lot of interesting points that I'm very curious about. But just a disclaimer for the audience, we're going to be talking about SPACs, which can seem very counterintuitive to someone who's a value investor. But I want to highlight that you yourself are very much a value investor, but have had a really great streak of investing in SPACs. And I'd like to kind of start there. What drove you to SPACs in the first place? And you've been doing this, I think, for 10 years now. So what's that journey look like?
So I'm definitely a value investor. I definitely think primarily about the downside and risk. And kind of my day job is quantifying risk. And if there's good news, it's kind of the inverse to whatever you've put at risk. I like interesting structures and I like quirky processes that you can kind of analyze. And so we've been doing this for a long time. It's only recently become kind of part of the kind of media interest and vernacular in investing. But what was interesting to me was that the structure involves a free put in the form of embedded trust value, and that trust is redeemable. So I've kind of joked about speculative investing and kind of cool kid, growthy stuff. I would love to do that if only I could get my money back if it didn't work out. And to me, value investing is having some kind of margin of safety that you're going to get something if things go horribly wrong. Well, SPACs literally contractually hand you that. You make the investment, and if it goes horribly wrong, you get your money back. And so the free put is the right to redeem the cash and trust. The free call is you also get warrants with your equity, and you're paying par. So you pay $10, you get a share, you get some warrants, upside kicker, you get cash and trust, downside protection. And you get some dude who looks for a deal. You try to pick a good dude. You try to, somebody typically, somebody that you have confidence in their history and skills as somebody to find a deal. But you have this structure that was uniquely interesting to me, and that's why I got involved.
So as I understand it, speaking to getting your money out, I'm under the impression that happens fairly quickly after you discover what company that SPAC is going to merge with. Is that the case? Meaning, like, is there a limited period of time you can get your money back after you now know what the merger looks like and if you approve or not of the deal?
Yes. So it's a fairly typical SEC review process that's actually been slowed down massively this past year because with this glut of SPACs, the SEC has kind of been swarmed with things to do. And so it's now kind of a matter of months between a deal gets announced and then you have to get the definitive proxy approved. So sometimes you have a few preliminary proxies, they go back and forth, approve it, 20 business days, vote, redemption deadline, and then on. So you have a little time to analyze it. And typically the sponsors have a lot of incentive to do a full IPO style press of advisors putting out information and press and conferences and so forth. So there's a decent amount to hear from. Now, from the founder's side, that brevity is a virtue because you don't have a lot of flux in terms of employees and other problems where it's actually shorter than the whole IPO process. So it can be an advantage to kind of flip it fairly quickly and have a little sense of urgency from the company's side. But you have, a few months to think about what you want, and it's getting market tested. You can either do a lot of deep, pensive, thoughtful work on the company, or you can just glance at the stock price. If the stock price goes from 10 to 50, you probably don't want to redeem and get the $10 back. If you hate the deal and the market loves it, you can simply sell it in the open market. If you love the deal and the market hates it, you can hang on. And if you both hate it, you can just get your $10 back. So the one thing I would say is that it has taken a little longer. So you have several months typically. And then the second thing I would say is there is a strategy out there that is not mine, that's fairly new with these very, very low riskless rates of return, where huge hedge funds with big calls on tens of billions of dollars that are well situated to use tons of leverage are now doing a form of SPAC arbitrage where they're simply buying the equity side at fairly tight spreads, but shorting out short duration debt against it at even tighter spreads. So that keeps the downside even before the redemption date, typically to $9.70. So like a 30-cent spread is kind of the lowest quality, trashiest SPAC, given almost no credit for an equity upside, typically is held to about 970. And there's this huge amount of liquidity. So, most shares you kind of lower penny by penny. Sometimes it affects the price. I mean, these will just get hoovered up at any scale. You could sell tens of millions of dollars in a print when you hit a yield that some hedge fund wants to set up for a SPAC yield arbitrage. Different strategy than mine, but it kind of gives you a lot of liquidity at the period in the downside, even before the redemption date.
You mentioned the opportunity potential of a $10 SPAC stock price shooting up to something like $50 to $60, and that actually happened recently in a SPAC that became Lucid, which I know you invested in, and it went from 10 all the way up to 60, but then it crashed back down again to 20s, mid 20s. It's again since climbed a little bit, but that sort of volatility is a little disconcerting, right, to the average investor. And does that play into the speculativeness of this asset class, if you will?
Yeah, it's a weird phenomenon that I'm in the middle of this. That was the biggest investment I ever had in anything ever. Actually, the one that you mentioned earlier this year. Disclosure we can do at the end or now. I still own Lucid, but the phenomenon is we bought a large stake of the predecessor SPAC at a discount to trust value. We actually weren't in the original IPO. We actually came in later and simply bought in the secondary market. Almost all of our investments are in the primary market, either via SPAC IPOs or pipes. We do very, very little in the stock market, although this was one that we were able to buy a huge stake at a discount to trust. And it was pretty clear to us that they were going to do this deal. There was an overlapping chairman of Lucid was an operating officer at this SPAC. At the same time, they put out a ton of job listings for an SEC compliance, investor relations analyst, investor relations director. So this is a company that's going to go public, probably via SPAC, probably via this one. And we were able to buy it at much less than $10 a share, $10 a unit, actually, even share and warrants. And the market had a very strong reaction, but you're long volatility when you own SPAC units, right? Because you own the warrants. And so I want volatility to go to infinity because if I have a portfolio of 20 of these, put $10 million in 20 SPACs and half of them go to zero, you redeem, and half of them go crazy and you own the equity and the warrant and you can sell for the market price. So to give a description of where the volatility went, we could get back our cost basis writing at the market calls against just the equity for a single month of premium. That's what the volatility did. So volatility is great, both for the warrants and for when options trade. Especially because of the strange interaction between retail-oriented trading apps. They create crazy arbitrages within the capital structure because these apps tend to have certain securities but not others. So if Robinhood loves options, likes equities, and doesn't trade warrants, then the warrants get completely disconnected from the equity. Equity gets completely disconnected from the options, typically bottom to top in terms of market reaction. So both on things that I quite like Lucid, and things that I don't like at all, like Nikola, QuantumScape, quite a few of these others, you have these just crazy disconnects in price where the price just breaks for a while. Typically that leaves us writing calls, getting some equity called away, and being very, very long the warrants, typically, but we're indifferent. I have no principle at stake. I just like owning cheap stuff, and I'm happy to be a service provider to sell expensive stuff if that's what people want. And then on things that are frauds or things that are frenzies, you can do the opposite and kind of leg into the short side of it. Similarly with these kind of arbitrages within the different securities. So in any event, volatility is great and frenzies are great for value investors in SPACs, weirdly.
Talk a little bit more about that discounted trust value, because you mentioned that was
Sure.
after the IPO. And was that
Yeah.
through a pipe or some other kind of
No,
investment?
that was a rare case for us, that we just bought the units in the public market. So units, there's no magic to it being 10. It's kind of the industry norm. You can make it 20 or 25. If you pick other prices, but call it 98% of these are at 10. So you can typically glance at a SPAC. If it's trading at 20 or 30 or $40, the market liked it. And if it's trading at $2 or $3 or $4, the market hated it after it's de-SPACed. This was simply the unit had IPO'd. The market had lost interest in it. It was trading at not a huge discount, because as I said, increasingly funds are kind of keeping the price fairly efficient to the trust value. But it was less than $10 per unit. And that was a function of COVID, really. That was a function of just as the market tanked, we were able to take advantage of that. While the equity gets quite buttressed, the weird little securities tend not to. So you have somewhat weird things like warrants. Those tend to be illiquid and trade irrationally. And then you have weirder things like rights, which are only the kind of the seedy underbelly of the SPAC world. It's basically kind of a bribe to beg people to invest in otherwise uninvestable structures, and those get crazy. I mean, nobody really follows them that carefully, and they're not that institutionally owned. They don't tend to have that much liquidity. Their price doesn't make sense. There isn't this aspect of tens of billions of dollars in weight to keep the price almost to the penny rational.
So I would guesstimate that a large majority of retail investors are more familiar with options than they are warrants. So maybe talk a little bit about the retail investing experience. If you went onto your brokerage account and you bought a SPAC, where does that warrant live in your account? Are you just given that automatically and it populates in your portfolio?
If you are on some of the online trading apps, you can't trade the warrants. The warrants get kind of orphaned. And secondly, you frequently don't have a lot of corporate actions. I mean, I feel like my brokers hound me on corporate actions just as an excuse to have a lot of interaction. Like, I don't think I've ever in 20 years missed a corporate action. I always vote. But sometimes there'll be something trading in the public market at $25, and you have a vote on whether or not you want to approve the deal. That if it was voted down and collapsed, would be liquidated at 10, and they have to delay because they can't get a majority because people just don't vote for these things. So we do, podcasts like this, and we blog and we write and we kind of interact with a kind of a breadth of investors. And one of the things we do is tell them, we own the same things. Please vote this. Vote your shares. And frequently I'll get a note, somebody say like, how do you vote shares? I've never done a corporate action before. So corporate actions are sometimes a hard fit for new investors on phone-based trading apps, and then warrants frequently are as well.
So with risk assets at all-time highs and inflation now hitting 30-year highs, there's been a lot of discussion around where to park cash. And I'm intrigued by this concept of, utilizing maybe a basket even of SPACs as somewhere to park cash, because it seems to have, as you're kind of alluding to and talking about earlier, this downside protection and the upside is unlimited, right? So maybe talk to us about the mechanics, or maybe talk to us about what a portfolio of SPACs might look like, or what kind of goes into picking that.
Sure. I mean, I love stuff that is kind of a Swiss Army knife of investing where you have the cash-like aspect on the downside or treasury-like aspect on the downside and equity-like aspect on the upside. So kind of in my personal account, I love mutual deposits where I have kickers on options to participate in equity offerings. I have a big portfolio of refundable deposits on all sorts of zany stuff that can catch bids when people are really very time sensitive, want an OEM, planes, trains, automobiles, and they sometimes get equity offerings too, as Rivian had recently. And professionally, I love SPACs for the same purpose. So I can tell you how we do it, and different people can certainly structure things different ways. We typically come in at some significant percentage of a SPAC IPO. So sometimes 5, more frequently 10% of a offering. This is something that it's very sensitive to us because it's only opportunity cost. I mean, all the risk is opportunity cost, but we like to go in with teams that we like and respect. So we have kind of a hierarchy of, and you can call it a negotiation, but at the low end, it really is a negotiation. At the middle end, it's a little more balanced. At the high end, it's more like begging an invitation. But we have teams that have demonstrable history of successes of finding really good deals. And we try to be very flexible capital. So we have a lot of available capital to come in later, to do a pipe later, to do other types of things, so that when we show up with $1, I'm really thinking about $10 in the back of my mind of different ways that we might want to be involved. And we sometimes also have risk capital. So we sometimes are also on the SPAC sponsor side as well. We sometimes come in when they find a deal, then you sign an NDA and you have MNPI, so you can't trade. But I don't do that much in the stock market anyway, so that's not that constraint doesn't really change my life that much. But that's where I can actually look at the deal, and that's a lot more fun. I mean, analyzing a shell company is kind of pretty boring S1. I like reading SEC filings, but that even stretches my entertainment value of reading about. It's somebody you know in a structure that you negotiate or do have a back and forth and say, hey, I would like to invest, but this is what I need to make it make sense for me. And that's why they always have minutely different structures. So in terms of how much cash is in trust, because more recently when the market was hot, you had the advantage of you got these big pops. So you'd put in, we had a big investment in Liberty's corporate SPAC. I don't recall exactly, but I think that was trading up like 20 or 30% above trust almost immediately. So yay, you get to make all this money in these pops. But the flip side is when it gets really cold, they do things like overfund the trust. So you put in $10 and you don't get $10 back, you get $10.20 back. And so you actually get a bit of a yield, a little bit lame, but by the standards of 2-year paper, not bad. It's better yield than the treasuries. And so you kind of have one advantage or the other. So we have kind of all of those different ways that we approach it. And then we find a team that we really like. And ideally, because we do a lot of due diligence, there's a lot of research involved in each of these deals. And there's a lot more to look at once they actually find something and you decide if you want to do the pipe and invest in the company for the longer term. But ideally, you find a team you really like. So instead of kind of doing a lot of background on that person, you can do it once and then do 4 or 5 deals. And so we've had a couple opportunities with our biggest pipe investments, with our biggest SPAC investments, where we can do that.
We've mentioned pipes a couple of times, and I'd like to kind of dig in on those a little bit more because it stands for private investment in public equity, which to, your average retail investor, I think that deserves a head scratch. You're kind of like, wait a second, what? You're getting a private investment in a public offering, essentially. How does that work, and why is it available to only seemingly institutional type of investors?
Sure. So it's a contract, you negotiate it back and forth. The parties to it are kind of, it's a creature of the parties to it. So it's more like buying a house than buying a stock, right? Like, so it doesn't scale down just like buying a house wouldn't scale down that much. So it's typically, a small one's millions of dollars or tens of millions of dollars per investor. Typically, I guess you could do smaller. I've never really done one that wasn't, a pretty substantial amount of capital that they were raising. So, we, and I can't talk about any of the current ones because of, you sign NDAs and the ones you're working on. I can kind of talk about past ones and kind of the situation. So something like AirSale is one that we took a significant stake in their IPO. And then they found a deal that we really liked. Disclosure, we're very invested in it. Then when they find the deal certainty really matters to the target. And one of the things I try to provide, I always try to be the most sponsor friendly outside minority passive investor. The typical way to get good allocations is just to trade a ton with Wall Street. So if you're, say, if you're my broker and it's like, hey, I do $100 million of fees that you get every year, give me this allocation, you do it just as a kind of payola for fees. We're not active traders. We're kind of a research shop. We're not really a trading shop. And so if I can't get close to Wall Street, because Wall Street doesn't have any particular reason to care about me because I'm I'm like the worst client. I have tons of corporate actions and complexity. I probably have the greatest ratio of complexity to fees of like any investor in the world. So we're doing a lot of complicated stuff, but we're not really doing a lot of trading that really benefits Wall Street that much. So if I want to be relevant, I have to be helpful to the sponsors. I have to, and one of the ways we do that is we're very flexible. So a typical demand for somebody who's an outsider investing in risk capital would be, I want to be senior, whatever you find, you can't negotiate my equity. I always tell them the opposite, negotiate my equity, have it pari passu with the actual sponsor insiders. And the reason is I want the pie to be really, really, really big. And even if that constrains precisely how I'm set up, you're negotiating the same thing for yourself. The problem is if I'm very inflexible, then you have to be ultra flexible with your own economics. And what I mean by that is you find a company founder, you're negotiating with them, and I have this like chunk of your equity, he has to deal with that. And so if you want to switch it to an earnout, or if you want to switch around how that equity is treated, you're trying to encourage him to roll over his equity, I create this problem. And so it's kind of like short-term greedy, long-term stupid in a way that I really try to say, no, I want to be a good partner. And so that's kind of how we get into the best deals at a smaller scale than most of our peers would. Just trying to kind of think like a SPAC sponsor to get really good deals. And the problem with really good deals is they have pushy founders because they have a lot of inbound interest. PIPE, you negotiate, you come in, you get to see the deal. So it's much more fun due diligence. You can't trade at the time or talk about it at the time clearly. And then the economics vary, right? So, sometimes in a difficult situation, in a difficult market, you're also getting a combination of securities and terms that might actually be at a big discount. And so where a IPO might be $10, you might be coming in at $8, or you might have protection down to $8, or some other virtues in how it's structured. And the cool thing about that investment is it also kind of protects your earlier investment. If you're already pot committed, you can come in and make something, push over the finish line. So if you own a lot of warrants, you come in with a PIPE investment, you can kind of push those way into the money.
Now, pipes and SPACs, do they go hand in hand? Can you have a pipe in just an IPO of any company without a SPAC, or vice versa? Are they always tied together, or not so much?
They don't have to be tied together. The reason why they are often thought of in conjunction with a SPAC is that a SPAC has raised some peculiar finite amount of money. Then you find some target, and there's no particular reason why, if it was my SPAC and your company and you want to combine with my SPAC, like, why should your company be worth the precise amount of cash that I have in my trust? Now, one of the ways you can tweak that is how much of your equity you roll over, so the predecessor will own some of the equity. The SPAC sponsor will own some. The SPAC equity holders will own some, but the pipe is kind of the flux. I mean, it accomplishes two things really. One, it then lets you scale to hit the right size of the consideration for that company. The other thing it does is it kind of backstops getting the deal done. Because if you don't know for sure, if a SPAC sponsor is trying to negotiate with the founder and say, hey, I have whatever it is, typically something like $300 million in trust, I'll pay you the 300 million, except if people want it back, right? So there's that kind of strange aspect to negotiation where strong hands with the sponsor can make the negotiation go a lot better. So if you have the top tier, top performing, experienced SPAC, one way to glance at it is if there's a Roman numeral in it. If there's a Roman numeral in the name, it's probably the dumb guy on the board whose dad gave him the job. But if there's a Roman numeral in a SPAC, it's probably an experienced sponsor because they've done something before. I've always thought it was funny. You could always just name your SPAC, ABC SPAC 7 or something like that. Like there's not a law against putting a number at the end of it, but I guess the market would find that out. Have some kind of history makes a difference. But a pipe says, hey, we have the money. We have private investors coming in. This deal's going to get done. And so you can perhaps get a better deal or pay a little less than if it was in flux where there's the cheesier deals that have a minimum cash requirement and that cash requirement's not covered is dicey to the last minute and not clear why a really high quality company would put up with that.
Very interesting. So yeah, if I'm comparing it to your real estate example from earlier, it's sort of like this escrow, these two escrow accounts. One is a very secure potential buyer, right? The pipe, that's locked in capital, with the SPAC that has more capital, but it's a little bit more, it's a little bit more risky, for lack of a better word.
The story you want to be telling, and really anybody that I would want to put a lot of my own money with, is this deal's going to get done. And we're going to be helpful and relevant to you. We have people with public market experience, which you might be a genius business founder with some spectacular technology who's never even thought about the public markets before. So we've just put 5 of these through a pipe that has investor relations and public relations and a public ready CFO, because those are the functions. I mean, the regulatory functions, kind of a grown-up finance person is the function that even a spectacular multi-billion-dollar tech startup might not have really thought of that much. I mean, especially if your growth has been meteoric, you might have been kind of a startup fairly recently. And so the world of dealing with the SEC is new. Well, a SPAC sponsor is probably, an experienced one might have done it 5 times in a row. So it's kind of like, you're definitely getting the cash. And then there's some other good news is the kind of one you want to be involved in, not you might get the cash or not. And then there's some other bad news because we're kind of a mess on our side. And the SPAC world, as it exploded, it kind of has a lot of both. We've had an era as recently as the first quarter where everything was trading hot, and then an era in the summer where everything was trading cold. And now it's kind of gotten to be meritocratic where the market's starting to pick out winners and losers, and it's doing so in a way that makes a lot of sense to me. And I think it's really healthy, and it's kind of serving well the kind of ones that I'm in and like, and it's kind of starting to sort out some of the irritants of people who have no business touching this much money and are going to do wacky deals and distorting prices and so on.
Well, speaking of experienced sponsors, one in particular I'd like to talk about a little bit more today. Is DMY Technology, who has done a number of SPACs, and I think you've participated in maybe all of them, it sounds like.
No, they're my favorite. They've been my favorite for a long time. And my interest really in them is not the thing that's kind of coincided subsequently, which is my interest is really on the technology and business side. They are very thoughtful and they're very long-term oriented. And if I'm stuck in something because of how we get set up in these, we're getting in at a very advantageous time in a very advantageous way, but we're going to own these from the beginning to the end. And we frequently have, more and more of our capital come in through different means, through the IPO, through the pipe and elsewhere, and often in risk capital. These are the guys we want to kind of be in for the long term. Niccolo De Masi is, I don't know that you need a separate disclosure for saying he's a friend, but he's a friend and somebody I quite admire. He's very savvy on tech. My focus has always been on finance. I am not a tech specialist in some of the areas that we've gotten very big investments in, but he's somebody who I've always liked his judgment, trusted him on higher tech deals. But he's had a really good record, Glue Mobile, professionally, the CEO, and his deals he's found have been, we just liked them all. He did Rush Global, Rush Street Interactive was the first DMY deal. That one's trading now over $20. So just they've taken out the warrants. So it's much better than a double because you had warrants that came with it, but like just call it just the equity that you paid, $10 for, and you got other stuff with it. It's been more than a double. And that was fairly recently. Their second one is Genius Sports. Things like $14, something like that. And then you got warrants too. And so those both were quite good. INQ, their third one, and that's at that point was the one we were, by far most involved with. It's like over 25. And then the next one is Planet, DMYQ. Disclosure, these are investments of ours. But Niccolo is the most successful SPAC sponsor based on the de-SPACed equities value. So not based on kind of short-term trading during a SPAC, but like once you're past the trust, so once you're kind of beyond the arbitrage games of trust value and this or that, and you're just looking at what's the equity actually worth, he's the most successful ever. There's more famous ones, Chamath and Ackman and Richard Branson, but in terms of outside minority passive investors making money, Niccolo's the best SPAC sponsor in history, and I think by far. I mean, I think there's others, maybe one-off ones, but just these have all worked. They've all worked really well, and so. And I would have been involved. I kind of coincided in things that happened to have been kind of things that got good market reactions. I didn't really expect it. That wasn't why I was here. And then some of these are very kind of by their nature long-term. INQ's the first public freestanding quantum computing company. It's an extremely important company. There's kind of two modalities of how quantum might work in the years ahead. And there are huge companies that are working on this, like Google and Amazon. But in terms of standalone investable companies, there's only a couple. And in terms of the ion capture technology, one of the two ways, as opposed to superconducting, which is kind of the other modality, it's IonQ. What's that worth? As a value investor, I'm a lot more comfortable buying something at a discount to book value, and that's not this kind of thing. But it could be a spectacular investment. I think it's spectacularly important as a company, and we're really, really happy with that one. And that's just the last one in kind of this litany of success that he's had.
You mentioned those two modalities, superconducting. Superconducting and IonQ. Is IonQ the second?
So superconducting is so Rigetti is the company that is kind of known for superconducting. Ion capture is the technology that IonQ is known for. I think that quantum has an incredible market opportunity. Just this past year, Google, for this first time, was able to do something with quantum computing that would take, 10,000 years with any traditional computer. We're at a point in quantum that if you look at the physical spaces, if you look at the kind of spaces that these guys are working in, it looks like something from the 1940s and 1950s, 20th century
projection of the future sort of thing.
You know, geniuses in these crowded rooms with all these wires and so forth. That actually separating the scientific challenge, the physical engineering challenge of getting these computers set up is quite a brainer. I mean, and so you're inventing almost every step of the way. And so, I mean, there's years ahead of challenges. But if you start at the end and work back and say, who's going to have an important role in solving these, there is currently one and eventually one other pure play quantum computing opportunity. And then the rest of it is a very small part of Google, a very small part of Amazon and Honeywell, actually, and some much bigger companies. But IonQ, if you look at the IP, if you look at the engineering talent, it just has a lot of the smart people who are going to figure this stuff out. So it's an important company. It was a company ready to go public, and a company that I think it's just going to have a lot of market interest. If you look at the mechanics of how these things work, as soon as the market sees the deal, and because you have the normal SEC process of going from a deal announcement to a shareholder vote, redemption, and close. As soon as you find something in the market that gets a positive market check, in a lot of M&A, a banker from Goldman can just leak something to the Wall Street Journal and then kind of see for a few days, hey, do they like it or not, and then dump it if they don't, do it if they do. But this is kind of just a overt market check. And one thing nice about IonQ is in an overt market check, people were really interested. People wanted to invest in this. People were convinced by this idea as an investment. And so by the time you get to the redemption deadline, you get almost no redemptions. So you actually get for the company not only your own capital put into it, which is great, so I wanted my capital in this, but I also wanted them to have the runway associated with a successful SPAC combination. So in this case, and there's always like, I always want to get a phone number for the people who, you know, whenever it's like the people who, it's like the people who go to Berkshire and vote against Warren Buffett for, you know, his board seat. Like, I wish they had a phone number. I was like, just tell me why, like who are these people? You know, whenever something's 99 to 1. And so like people, there always is somebody who redeems for $10, even when it's trading at a big multiple of that. And so I think like, geez, you know, $12 is more than 10. But it, you know, once these start trading really well, it has a little bit of a self-fulfilling aspect to it, in that the vote goes through. And one change, by the way, in the decade since I started this, is the vote used to be tethered to redemption. You can actually vote for the deal and still redeem. So you have no particular reason ever to vote against a deal. I mean, the votes almost always go through. They did in that case. There were almost no redemptions. And then as a public company, it shouldn't really change that much because, you know, it should be discounted that it was probably going to happen, but it goes from the old ticker related to the SPAC to its own ticker. So it's, you know, it is literally the name and the ticker is IonQ. You have sell side coverage for the first time. And then some long only mutual funds and different investment institutions actually don't have a mandate that allows them to invest as a SPAC, and they can invest as a public company. So sometimes that makes a difference in the supply and demand. I know in the case of AirSale, we think it's reasonably likely that they're going to get added to the JETS ETF, and then there's actually a new leveraged Direxion ETF that could get added to that too. So there's some kind of just market supply and demand dynamics that are affected by the deal actually getting done. but when INQ got done, it's done extremely well. It kind of I don't follow these things every day, but it kind of well, since we're talking about it, I'll follow it. It traded up from $10 to 28, and their warrants, and the warrants are typically 5-year warrants to the 11.50 strike price. I'm curious, since we're talking about this, and their warrants are at $16.41 right now. And so that's pretty dramatically good so far. And I think a bit of a market check on what is happening in SPACs and also what's happening in quantum computing.
Well, DMY has a fourth SPAC now. The ticker is DMYQ, and they are set to merge with a company called Planet. And I got to say, this company might just be the most interesting or exciting company I've come across in a long time. I just had Josh Wolfe on the show, who from Lux Capital, who's an early investor in Planet, and we talked a little bit about it. And I'm now more intrigued by the company. So I want to talk and dig in a little bit on that company in particular. It is essentially let's start there. I'd like to hear your overview of the company and
Sure.
the prospects and what it's done to date.
So Josh is going to be much smarter than I on the technology, and I hit it from having been involved on the SPAC side from day one, or even before day one. I was involved in this from the beginning, outside minority passive investor, but concentrated position in this, and one that I came in with this with risk capital, participated in the invested from the beginning, and have a big stake in this at this point, assuming the deal goes through, which I think is highly likely. Shareholder vote on December 3rd, should be public shortly thereafter. Ticker PL. I guess this is an obvious and redundant disclosure, but I am an investor in the company. And it's just a vintage Nicola DeMuth deal, the kind of thing he looks for, the kind of reason I invest alongside him. It is a network, actually a couple overlapping networks of fairly low orbit mini satellites. I mean, tiny little cheap satellites with unbelievable fidelity, Earth imaging, and daily. So organizations that had to wait, a year are now getting a daily imaging. I would say the company's product is A+ and a huge competitive advantage. And I don't know if anybody's ever going to keep up. And I think they're going to be the ones to disrupt themselves. I think they're way, way, way ahead in this product. I think their sales efforts have been good, but if their product is A+, their sales efforts have been B+, because they kind of have just raced ahead in what they have, and kind of, if we build it, they will come. I don't know what it's good for. I can say, as a future customer, I can think of a half dozen things that I'm going to use it for that they've never pitched me on. And I suspect every industry has their eye on something. Everybody's going to be a Planet Labs customer. My priority as a market participant, if you were looking at a retail opportunity, say, you can be a customer, you can be a data scientist that uses real-time data to know things, or you can get out of the markets, or you can get destroyed if you're coming up on an earnings report and you're guessing on some hunch, and the people who are Planet customers, they already know. I mean, they know. If you have credit card data and parking lot data, and you're looking at, in a commodity business, you just say, well, our algos have just tracked how many trucks have left the factory every day. I mean, you get arrested for trespassing if you were doing it on the ground, but you just know. So I don't really know what else there is to do besides being good at analyzing data like that. But it's an incredible data set. And so as an investor, I can't wait to get my hands on all of it. I think I had 4 requests into Planet so far today. I mean, it's an amazing subscription. But think about this is something historically, it's the kind of thing that superpowers had. It was pretty much the US and the Soviet Union could go back and forth looking at things like this. But now it's going to be everybody. I mean, now you have any intelligence organization, any civil government, I mean, insurance after a hurricane, trying to figure out, who's defrauding you and who's a legitimate claim. You'll just look at it in that day. And so the difference between kind of getting to have overflight and seeing what's getting the changes, especially because computers are really good at saying like, oh, I'm looking at a million different data points, but here's where a road was cut legally or illegally. Here's where a roof was damaged or it wasn't. And these are two claims. I mean, this is the kind of thing that you're going to have the imaging and the analytics for. I don't know what else you do if you don't have that, but like, you don't want to be the guy guessing, competing against somebody who has it. So everybody's going to have to be a customer, and then they'll figure out what to do with it. But you just can't bet against somebody. I mean, you're playing Texas Hold'em with your cards that the other person can see. I mean, it's going to be impossible almost immediately. And so every industry will figure out what the ramifications are of that. I can kind of figure out the ramifications are as a hedge fund manager, thinking about finance, thinking about insurance, thinking about financial products. But there are certainly human rights equivalents. People debating whether or not there is a labor camp in rural China. They have the picture now. People debating whether asbestos is being illegally dumped by a river. They saw it wasn't there yesterday and it is today. I mean, so many things that used to be Sherlock Holmes sleuthing is just handed to people in almost every scenario you can think of. So it's kind of spectacular. The infrastructure itself is pretty cheap. Individual satellites, these were bought from Google. Google's a huge investor. They were kind of an early investor, and they're major in the pipe. And they sold a Google business to Planet Labs, and there's a lot of Google people back and forth. So it's Google is, you could mistake this for a Google subsidiary. If Google ever wanted to buy it, if the current owners ever wanted to exit, you could imagine it would go to Google someday. But they're happy as a separate company. It doesn't really need to be that either. But it's just, I think it's just going to be hugely important. I mean, I think it's going to be one of the most important companies out there, and it's going to be just one of the data sets that the customers will start to kind of define what it's for. And they don't have any explicit kind of program for customers bringing in other customers, but I think it's just going to go like a wildfire through, agriculture. You can look through clouds, and because they go so frequently, they can pull out all the clouds and just show you the soil, show you the crops, and there's just some answer. And that used to be something a farmer would have to sweat, and now it's just, it's just known. It's not even the good news is there's going to be so many interesting things to think about in terms of how to use this. The bad news is I'm sure there are a lot of people whose judgment, whose kind of horse sense created kind of a pre-Moneyball career and identity for guessing things where the value of guesses are going to have no market value anymore.
Yeah, and just for some further context for this company, I mean, 100 million in revenue already, I believe, just as of January of 2021, 600 customers, over 65 countries. They have between 400 to 500 satellites in orbit, low Earth orbit right now. And what you're speaking to, just for some further context, I heard Will, the CEO, talking about how it took him 6 years to get this up and running. They've got a huge leg up, and they're probably going to be, I guess my question, as it stands today, they look almost like a monopoly or a duopoly if you add SpaceX to the equation, because SpaceX has its own fleet now of satellites. I guess my question is, are they at risk? They've got to put these satellites up every 3 years, because they kind of fall back to Earth. And I think they're using SpaceX more or less to get them up there. Is SpaceX a competitor waiting in the wings for this company that could eat the lunch of something like this? I'm sure people have thought of that way ahead of me, but I'm curious to hear your answer on that.
My answer is that people shouldn't talk about being a monopoly or pricing power, and that the general counsel of every company should take a little seminar for all of the salespeople and say, don't talk about pricing power, don't talk about being a monopoly. So it's not something I would focus on, even if I thought it had monopoly-like characteristics. I think the speed at which they've gotten this far is a big advantage. I think there are more ways to get into space than there are networks like this in space already. I also think that there are data aspects to how they are able to optimize and use their imagery that makes it very, very sticky. I think that you're going to see spectacular growth in revenue and in the number of customers, but I think, boy, I just don't think you're going to see anybody leave. I love pushing back on price, and every time I go on vacation, I cancel everything. I was once listening to a quarterly conference call, and I heard how much money the cable companies have set aside to negotiate with people who leave, and then I was like, oh, you should always leave, and then I want some of that money. It's very hard, if you're willing to make a pest of yourself, for the other side to not split the difference and cut your costs a little bit. And so I just kind of reflexively do that. And then one day I tried it with Bloomberg, and I've never been so completely rebuffed on a effort and a foray into pushing back a price. I was like, wow, that is a really good business. I mean, my firm needed it. They knew we needed it. And the contract is completely one-sided. I don't recall the specifics because this was years ago, but I think even if we completely went bankrupt, I think that they even have like a senior claim to it's just an incredible subscription business. And Planet is Bloomberg for Earth imagery. The second best is going to be too little, too late. And for the scale of decisions you're making that are affected by it, you don't really care too much, because the costs are going to be, and how it works is, for a lot of the data that we would need, it's just the regular satellites. You can actually, they have ones that are kind of optimized for specific sites, but just the regular kind of slices, it's kind of like an apple peel that goes around, and it actually uses the rotation of the Earth. So it's actually just kind of going around and taking these images. I just don't think, I think the customers are going to be very, very sticky. And if there's competition, great. But I think, and this is a falsifiable claim, but in the next 2, 3, 4 years, I think you're going to see spectacular growth. And I think it's going to essentially all stay.
Yeah, well, again, that TAM being almost unlimited is pretty promising. When you mentioned the competition, though, the fact that it's a very powerful tool, and especially for, as you kind of alluded to or mentioned earlier, around governments and defense, and there's a whole application for this kind of data, that it kind of raises this question around, will the U.S. step in and try to claim rights to the data and exclude other countries, and would that set off a number of other competitors and other countries launching their own their own stream of satellites to get their own data? You see where I'm going with this? Is there a incentive structure in here that some exclusion could kick off or ignite?
Sure. And a lot of the customer base is going to be civil and going to be industry and going to be NGO organization, not kind of security sensitive. I think as the need for this becomes almost ubiquitous. I think there could be growing pains in the national security side, but I think it's ultimately more fraught for the national security efforts than it is for the company. Sale, and when GPS first came out, they tried to scramble GPS so that it wasn't highly accurate. And there were not, you can always use words about national security to justify anything, and you can kind of imagine, you can say allegorically why it makes sense that private citizens shouldn't have their own GPS. And it was annoying if you're a sailor, because having very accurate GPS is helpful for individual rocks and shoals and so forth. And they were actually really crude on how they scrambled it, and I figured out a way to unscramble it. But they tried it for a while and then they gave up. I think trying to limit Earth imagery, it might be like that, but I would bet on the market against the government every time in this case. It is going to be ubiquitous to have access to this, and it's going to be necessary. And I think that as the customer base builds up, it would put a country more in peril than the market to try to stand in the way. I mean, I just think it's going to be very, very hard. Now, I mean, on the edges, we don't want terrorists to use this or something, sure. But I think that the vast majority of customers will be, indifferent to national security. And on the edges, will there be some issues? Sure.
The other, you mentioned Google being an investor.
Mm-hmm.
It's interesting that this company is choosing to go public. And,
Mm-hmm.
I almost wonder if it were wrapped up into Google, it might be worth $50+ billion on its own already, just living in that ecosystem. Is it just that they have their sights set on, being the next $1 trillion kind of company, and they've held out and they're going this route, or is there other reasons to go public for a company like this?
Well, it's kind of the best of all worlds, because when Planet needs capital, they get capital. So back to what's the point of a pipe, you can kind of top off the needs, right? So Google owns whatever it is, it's a little 10% or something. They have the capital that the smaller company needs. The bigger company has access. You have personnel that are kind of have, even you can get data off of like LinkedIn. It's all public, but that are kind of meshed back and forth. You need things they now have. You need grown-up finance people, SEC compliance, public company ready. Even just IR functions, PR functions, they're 100% set for that. And that's one of the advantages of the fact that it's called DMY4 for a reason. And the fact that Nicolo, who's going to be on the board and is, he's a fairly young guy for being very seasoned as a public company CEO, who had an entry and an exit, who has had multiple of these before. It has all the upsides of kind of being kind of adult supervision. But if you're a young, hot engineer doing something cool, it's kind of cool to have a big stake in the thing you're actually working on. I mean, it's cool to own a lot of Google stock too. But if this thing really explodes, I think there'll be a little more public awareness. And I think the breadth of the type of customers, I mean, you'll have people like me who's going to be an investor customer. And I think you'll have a lot of people in that category. So I think there's just some more awareness. I mean, imagine if Google wants to, Google could put a link on their homepage. I mean, they can do with this whatever they want in terms of the upside. And I should also say, you asked about regulators. There might be some higher level of comfort with an independent company making decisions on the basis of this product than being more integrated. There's sensitive data in terms of not just the imaging, but how the imaging's being used. Like if you're a subscriber, what are you using that for? I think that there might be a higher level of comfort from people who are aware that data is just in this one silo and not being shared with other functions at a bigger company. I'm not a conspiracy theorist about that. Google buys them someday, I would still be a customer, but there might be some preference to have it somewhat silent.
All right, so let's talk a little bit about the deal structure, the capital structure
Sure.
of this. If you're a retail investor and you're buying into the SPAC it's a trust. It's got about 350 million. There's another pipe on the sidelines for I think of what 250 million at this point, and the valuation post merger is estimated to be around 2.8 billion. So if I'm a SPAC holder and I hold one of those shares, what am I really getting at the end of the day as far as a real piece of this company?
So the IPO proceeds, 345 million, and all of this is going to be, and the deal size, two and a quarter billion, but the deal size is also predicated on that we will have essentially no redemptions. And so one of the things about this sponsor, this team, and this structure is it's highly likely that we're going to be dealing with close to no redemptions. But the other thing that I always look for, kind of hope for, is there are a ton of SPACs right now, and there's this worry that what you're dealing with is an exit for the people who are smart about it and a disaster for the people who are coming in. I mean, there is, I think I won't say which one, but there is a very popular SPAC sponsor with one that's been a train wreck of a public company so far. And I talked to some of the people who are involved in the bidding war for the company that he bought. And the second highest bid was 30% lower. That was not a SPAC. And that was a much more typical kind of market check for that. So he was bidding significantly above what anybody else wanted for a story, for a SPAC. And the people who sold used a lot of the proceeds to cash out. And so that is not what's happening here. It's combining, but the current equity holders are going to be equity holders in the public company. And so they're going to be here for a long time. So the specific percentages kind of will get tweaked once you get through the vote. But this is a combination where pipe holders will own some, the current equity holders will own some, and the public company holders will own some. And then we also have to deal with the warrants, because it's just complicating the structure a little bit further. I joked that one of the kind of shorthands for SPAC experience is just check the Roman numerals. The other one is look at what is nominally a generous structure to an outside investor can also be a bad sign. Like if you look for somebody who is inexperienced, somebody who doesn't have a track record, somebody who shouldn't really be sponsoring a SPAC, they have to kind of bribe the investors. So you'll overfund the trust. You'll put in 1025 instead of 10. You'll have maybe a full warrant, maybe rights. And how rights tend to work is every 10 rights, you get another share if a deal is getting done. As Nicolo's history has been so good, as his de-SPACed equities perform extremely well, somebody like me is happy to go along for the ride and doesn't have a lot of negotiating room to say, hey, I'm demanding this, that, and the other thing. So every time he does one, you get less and less and less warrants. So this is kind of, it'll be interesting to see after this. I think it was kind of a third, then a quarter, and this was a fifth. But the warrant is a big part of the cap structure. So dealing with that, and what happens is it's a 5-year warrant. It's reasonably likely that at some point in the near future that there'll be a redemption deadline. And if they redeem you, literally, I think redeem for a penny, so you don't ever let them redeem you, exercise your warrant, and that people will then exercise the warrants at 11.50. So you'll have the warrant holders own some significant amount too. Rule of thumb: fiduciary duty is always to the equity holders. So assume they're not your friend in terms of how you're treated as a warrant holder. It's a warrant. Everything other than equity is a creature of contract, not fiduciary duty in the same way. So you'll get whatever the bare minimum deal you could imagine getting, but that'll be dealt with in the near term. So those are the kind of different silos. But it's a very good thing that the old guys will end up, owning a significant amount, and that's how you can turn $345 million trust into a $2.25 billion deal size. So yeah, and they'll kind of lay that out a little bit more once that comes out. And then I should say the other aspect of it, and it gets a sense, and this is kind of an interesting one once you get towards the end of a deal, but is the at-risk capital. And the at-risk capital is, if you are an outsider, you put in 10, and at worst, if things collapse, you get back 10. But if you're an insider, 345 million in trust, the insiders put in, in this case, it was $8.9 million of at-risk capital. And so people have exposure that they don't get back. And that's the decision makers, that money goes away if you get to liquidation. So that's kind of the lay of the land there. And that's their big next one. They have, and then they actually have number 6. They don't have number 5, but they have number 6, and that hasn't found a deal yet. But those are the DMY deals.
So just for first-time SPAC investors, when you hear that it's going to be a 2-point-something billion, 2.8, 2 point, what you said, 2.25? Is that what it says? Is that okay? $2.25 billion valuation post merger. Essentially, what you're saying is that the market cap essentially of the SPAC is 345 million, right? The same valuation of the cash sitting in the trust.
Yep.
Whereas when it merges, it's going to become the market cap of the valuation at hand, and then it'll be priced accordingly, correct? At time of merger.
Yeah, and so all correct. And then the equity value goes to 2.8 billion when you look at kind of all told the committed pipe, and
the post money,
and so you have the pipe in this case was 200 million, and so that was BlackRock, Koch Strategic Platform, Mark Benioff, and then Google topped up. Like Google was already big and they got bigger. So you had, the other thing I always like to see is, I always like to see some kind of industry participation in a pipe. Like a pipe can be a very good investment. People like me invest in pipes, but it's also important to see like partner type roles in pipes. So it's kind of like, nobody knows this better than Google does. They had a big investment. They saw this and they're like, yeah, we want a bigger investment. And so that can be kind of a good data point for kind of just the health of a deal that makes sense. And 77% of the company will be the existing owners, and so this will be the inverse of that, which you don't know the whole thing, but you have the data point of the insiders. We're buying, but they're not really selling. We're just kind of combining and becoming public.
Very cool. Well, this has been a really interesting discussion, Chris. This opportunity with Planet especially is very intriguing. I'd love to do more of this. I'm really interested in the SPACs, especially a portfolio of them, as I mentioned earlier. Just very interesting stuff. And thank you for providing a little bit more of the more optimistic side of SPACs today. And I think our investors will learn a ton. And we'd love to have you back to do it again sometime soon.
Thank you. Yeah, we can do the pessimistic side. I have a bunch of these there's a lot of good short opportunities in the SPAC world. And the other two things is the dumpster diving on broken SPACs. When they go from 10 to 2 or 3, there's some good dumpster diving cheapies, and then the future of public quantum companies. So those are the 3 things that are on my mind for some other time. But meanwhile, I really appreciate you having me on. Thanks, Trey. I really enjoyed the conversation.
Well, before I do let you go, I do want to mention that you write quite a bit about this. I want to give you the opportunity to hand off to the audience where they can learn more about you and find your writings and follow along with what you're up to.
Sure. So if you're interested, I write on Seeking Alpha. I wrote as recently as today on planets. So you can look me up, Chris DeMuth Jr., Seeking Alpha, and welcome to read anything there. And then I also have a community of long-term value investors called Sifting the World. And Sifting the World is from a Charlie Munger quote, and that is people specifically interested in event, special sits, kind of quirky, weird value investments, stuff that I like. And you can sign up for that if you're interested, if you're really interested on Seeking Alpha. So thanks for asking.
Chris, really enjoyed it. Thanks again.
Thanks, Trey. Enjoyed it. Have a nice weekend.
Thanks for watching. Make sure to subscribe and hit that notification bell so you don't miss out on the next podcast episode and new investing resources.
What are your takeaways and thoughts on this discussion? Let us know in the comments section below.